Welcome to Cardio Future, episode number 4. My name is Andy. Today I have a very special guest. His name is Aaron. Aaron has made a $50 million in 4 years of his business. It's a great honor to have Aaron as a guest in our podcast today. Sit back and enjoy the podcast. So welcome to the podcast, Aaron.
Thank you.
You're awesome. Now, Aaron, do you want to tell us a little bit about yourself and your background and where you're from?
Yeah, sure. So currently 35 years old, grew up in Sydney, around Hornsby and the Northern Beaches. And so background in terms of, I guess, career and how I got on the career path I'm on at the moment.
Yes.
Always been interested in real estate. You know, something in Sydney being one of the strongest real estate markets in the world. It's something that interested me.
Yeah.
And so then when I started working, I decided my first goal was to buy my first property. Mm-hmm. And so that happened to me, 2007? It was right before right kind of during that GFC process. I'd saved up, so Sydney market to buy an apartment, I'd saved up $110,000 deposit. And I did that through sales, just through, commission job. So I figured that was the best way for me to make money at that time. I wasn't working in real estate or anything. I just saved up that $110,000, bought an apartment for $525,000. And I guess it was good timing for me. I was early 20s. I was looking at a lot of the apartments around there and found that everything in the lower end price range, you'd have 30 or 40 people coming through every single inspection because you had low interest rates, given the time. You had property prices dropping because of the GFC. And I was looking at all these places going, yeah, they're not very nice. They're all selling around, $450,000 to $475,000. And so what I did is I jumped up a price bracket and I went and started looking at places in that kind of $595 to $650 price range. And what I found there was one of the ones we went to was, a beachside, 2-bedroom, 2-bathroom, 2-story apartment with 3 balconies overlooking the ocean. And they wanted $615,000 for it. And, being young and fairly inexperienced, I said, I'll pay $515,000. And, funnily enough, they actually considered the offer. I thought I was going to get rejected. They considered the offer. We negotiated back and forth a bit and then ended up at $525,000. And so for me, that was a massive win because of the time frame, he couldn't really do that at the moment, given certain, except in certain areas. But for me at the time, it meant I was getting in at a good price. So I got in kind of like, buy low, sell high type thing. The downside of that was I didn't know what body corporate was. I didn't know what strata management, everything like that was. And so when they told me that the body corporate was about $4,800 a year, I didn't even really know what that meant. I was like, yep, okay, no worries, let's do it. And so then for me, and also at the time interest rates, I think I was paying 7.7%, which was a lot lower than it was, 10, 15 years before. But compared to the moment where you're paying sometimes low 2s, to kind of mid 3s, 7.7% meant that my monthly mortgage payment, principal and interest, was a lot of the income I was earning. It was around about $3,500. And so one of the things long term about that property, I wanted to go and buy more, and I found that it was taking up more of my income than I was comfortable with. And so when 2009, a couple of years later, Australia was coming out of the GFC pretty well by then. And so I started looking around at what I could get for it, and I was able to sell it for, I think it was around about $670. And then that gave me a decent deposit. So then from there, I went and bought 2 properties. Still working in sales, still not doing real estate yet. At that point, I started studying my master's degree. So I did a master's of international finance. So I learned all about, share market, learned about currencies. And then I decided when I finished that I was going to go into real estate, just because of at the time, I was like, it seems like more people are losing money, in the stock market than making money. Also, I'd built up a few $100,000 in property, but I wasn't willing to risk that in anything high risk or high reward. So for me, I was like property, bricks and mortar, nice and safe. And so when I finished my master's degree, I started looking on the Seek website for jobs in Melbourne. Reason for that is because my wife was from Melbourne. We got married in 2007. I'm going to get in trouble if I get that wrong. 2007. My wife was 19, I was 23. And the deal was we would live in Sydney for 5 years and then we would go to Melbourne for 5 years and then we'd decide where we wanted to be. So 2012, once I got my master's degree, I just started looking for jobs in Melbourne. And kind of fate, probably a bit of luck as well. I went for a job at a place called Accrue Property, and that was a property investment company. I spent the next 5 years working there. When we started, we were doing probably around about 4 or 5 sales a month, targeting investors. And then, and today that company still does around probably about 50 sales per month. So one of the larger ones in Melbourne. And that, I guess, solidified me in real estate. It took me from someone that had bought properties from myself to, I guess, managing a business that's turning over $500 million in real estate. Kind of gave me, I guess, the credibility to do what I do now, and also the experience. So during that time, I also bought a number of properties myself because you're in the market, you'd see good ones when they came up. We worked with a lot of builders, learned a lot about the industry, and then 2016, I loved that job, loved the industry, loved the business I was working for. But my weeks were generally leaving home at 6:30 a.m, getting home at 7:30, 8 p.m, Monday to Saturday. And so when my wife fell pregnant with our first son, I just kind of said, it's not really for me anymore. I don't want to be the type of dad that's never home. And so I was like, I want to stay in the same industry, but I want to look for a way I can do it, more on my terms.
So you decided to start your own in 2016.
Yeah.
Wow, that's like a short time from 2016 to 20. You nearly made 50 million on turnover in real estate.
Yep, it's been a bit of a hard slog. But I was, my view was just keep doing what's working. Yeah. And so I didn't want to go down the same path as, I guess, what I had been doing. So I looked for a market niche. So my market niche was higher end investors. And I guess, a really good that Accrue gave me a really good kickstart because I could sit down with someone and say, I've managed a business turning over $500 million in property for the last, 2 or 3 years. And, this is my personal portfolio. And because I was fairly young, I guess, it gave me a bit of credibility.
So when you started, because I can see that you're really relaxed, you know what I mean, compared to a lot of real estate salespeople I've seen.
Yeah.
So what was your, you had a strong belief in this system is going to work because you understand the market, you understand the real estate industry, right? Yeah. So are you do you see any risk in it, or you are just this is gonna go only higher?
Okay.
You know what I'm trying to say?
Yeah, so my whole business model is revolved around, I guess, managing risk for investors. And so I look at it and go, I can look at the statistics. There's the marketing side of statistics where people will tell you that property is performed a certain way. And sometimes they're telling you that for their own ends. They're telling you that properties double in value every 10 years. But then they're trying to sell you an apartment where they're making a huge commission on, and they're using accurate data to sell you something that's not going to perform, that accurately. But I can look at it and say, okay, I can look at it, anything in Australia that is a house with its own block of land, 3-4 bedroom, freestanding, within a certain radius of a major city that has certain infrastructure around it. I can look at that and say, every 10 years for the last 40 years in Australia, that has doubled in value. And so that's as long as it even now, yeah, as long as it's under the median price of the city it resides in, and under the median price of the suburb it resides in.
Does this COVID-19 affected that value?
COVID-19 has affected values in different areas differently. So I've got a few clients in Sydney trying to sell high-end properties, and just common sense tells me that if we're looking at selling a $3 million property in Sydney, our buying pool is going to be decreased because people's incomes have been decreased due to COVID-19. And so then at the same time, people are working from home. They no longer need to live as close to a CBD. One of the reasons I relocated to Queensland is because I just got sick of the weather down in Melbourne. I loved Melbourne as a city, loved it as a work environment. I just didn't like the weather. Growing up in Sydney and surfing every day, I think I surfed about 4 times in the 5 years or 5-6 years I was in Melbourne. And so relocating to Queensland, at first I was worried it was going to affect my work. But then I found that I could do nearly everything remotely. And then I travel to Sydney, I travel to Melbourne. I have a real estate agency in Melbourne, so I go down there and visit. I was going down to visit frequently, but since COVID-19, I've not been to Melbourne. So I think my last trip to Melbourne was December last year, and it hasn't really affected my business. Yeah. So then going back to the question about property prices, I think that in the right areas, property prices are actually performing very well. And so, looking at what the government's done to combat, I guess, the economic slowdown, government's recently announced these home builder incentives. So if you're purchasing a property up to about $700,000 and you're earning less than 125 as a single, I think it is, and 200 as a couple, then you get a $25,000 incentive for building a property, as long as the value does not exceed 700,000. And so for me, I've found that doesn't suit a lot of my clients, because a lot of my clients are higher end and earning too much. But for that entry point, which, like I was saying to you guys, because you're out from the Ipswich way, in the last week, I've sold 2 properties in Ipswich and 3 properties in Logan. And those are perfect because they're, that $450 to $550 price range. The purchasers, if they're a first home buyer, are getting $15,000 for their first homeowners grant. They're getting $25,000 for the builder's grant. They're getting their stamp duty covered, which, on a purchase of a block of land, with a house on it, around about that $450 to $550 makes up for about $6,000 to $7,000 worth of stamp duty. And so from the very starting point, they have basically, $45,000 to $50,000 from the government to purchase the property. And so what I see happening there, as long as we're talking about houses here and not apartments, I'm not a fan of apartments. We look at this and we say, okay, those properties have a really good scope for growth up to that $650,000, $700,000 price range, because between now and the end of the year, we're going to have thousands of people entering the market that couldn't normally enter the market. On top of that, you've got interest rates in the low 2%. Look, I just bought 2 investment properties myself, dual occupancies in Logan, and I got my interest rate for an investment below 3%, which is kind of unheard of in the industry. A couple of years ago, we were doing 5%, and even last year it was 4.13%, and now the fact that I can get an interest rate under 3% makes all the difference to an investment.
So when you talk about the apartments, right? You are not a big fan of apartments.
No, I've purchased 4 apartments. 3 of them have gone up in value. But I look at it, when you talk about risks earlier, I look at it as what can go wrong with my property purchase. And so, the biggest reason I'm not a fan of apartments is the 3rd property I bought was meant to be my forever retirement pad. It was a penthouse apartment on DY Beach in Sydney. It had a rooftop pool, which my apartment and one other apartment shared. So we had exclusive access to the rooftop pool, had these nice glass windows that went down through to the lobby. And it was a really cool apartment, massive outdoor area. And me and my wife lived there. We loved living there. And then they started doing some work on the apartment complex, and we get a bill from the body corporate, basically for $50,000, telling us that we need to replace the skylights or the glass panels in the pool. And the only quote they got, which will give it a lifetime warranty, came in at $50,000. And so this was while I was studying my master's degree. I was probably making, low 100s, so a $50,000 bill was a lot for me to take. And really, I said, well, what happens if we don't pay it? And they said, well, if you don't pay it, the body corporate will take it, but then the pool will become the property of the entire complex as opposed to the rooftop. And so then instead of having a nice rooftop pool, we end up having, the entire complex sitting there on the balcony enjoying our view, and our pool is not private anymore. Yes. And so, and that kind of said, okay, luckily I was in a position where I had the money to pay for it, but if I hadn't, I could have lost that. Yeah, and so that's one of the things which that risk is not really going to come with purchasing a house or even a townhouse. And then the other thing I'm not a huge fan of with apartments is, it depends on the side. Like I have made money in purchasing apartments. Like the first one I told you about was a really good buy. But the other thing I look at is if you buy an apartment off the plan and you have, for example, 100 apartments, I look at what's going to be the fallover rate from. Like a bulk, you mean? You just say you're buying one of 100 apartments in a block of apartments in Melbourne or Sydney or Brisbane, and you say, okay, we're putting down a 10% deposit, we're paying $500,000 for this apartment, and then we're hoping at completion the value of the apartments has increased to 525 or 550,000. What I find happens in this case most of the time, unless you get a really, really strong property market, is that during that process, if there's 100 buyers, maybe 1, 2, 3, 4, 5 of those is not going to be able to complete the purchase at the other end, considering a block of apartments can take up to 3 years to build. And so then if I've paid 500,000 for an apartment, the builder obviously has his margin in there, forgets the time where the apartment's completed and 5 others can't complete the purchase, then the builder's more interested in selling those and getting his money out than he is in getting the highest price for it. And so even if there was capital growth during that process, if the builder can sell it to someone else for 500,000, the same price I paid 3 years ago, he'll probably do that, and that negates any capital growth I've made. And then if you look at situations like the Sydney apartment market at the moment, because of COVID, because of low valuations, because of Royal Commission banking last year, there's been some apartment complexes where you've got massive numbers that just are not able to complete on their purchase. They're defaulting, they're losing their deposits sometimes, and it's just a much riskier investment.
So you think investing in apartment is a riskier investment?
It can be.
It can be. That makes a lot of sense. So when you come down to the real estate, like the risk depends on the property.
Yeah.
It's not the crashes or the socioeconomic situation. It's where you invest. Is that correct?
Yeah, that's kind of my view. Is you can invest safely in real estate at almost any given time. Yeah. So since we've had, the last few years, we've had some really, really strong growth, and now I'm not. I never guarantee capital growth. I never say to someone, I'm going to guarantee this is going to double in 10 years, because you can't do that. But what I can do is I can look at a property and say, this is going to make X amount over 10 years, given these variables. And so what I like to do is then reduce the variables as much as I possibly can. So at the moment, what I'm selling probably 80% of in different areas around Australia. I'm licensed in all states at the moment except for Western Australia and Tasmania, just because I don't have any interest in selling there. But what I'm doing at the moment is cash flow positive properties. So because of low interest rates and because of, I guess, decent rental yields in certain areas, then you buy a property and from day one, with an interest-only loan, it's cash flow positive by sometimes up to $300 a week. And so for me, then I'm saying, okay, even if we got zero capital growth in the next 10 years, if it's making you $300 a week, nothing's going to make you sell that property at a loss.
That's right.
Like, the only time people lose money in property is when they sell it at a loss or they sell it in a bad market.
That's where they lose it.
Yeah. So for example, one of my football clients last year, he's purchased a number of properties. He'd purchased an apartment in Brisbane before he'd met me. And it was a great tax deduction because it was losing him money. But the problem was he got an offer to play overseas in the Super League last year. And it was a great offer, but we looked at his property portfolio and said, now that you're not getting your tax deductions, you're not earning money in Australia, you can no longer really afford to keep this apartment. It's losing your money, because you might have a portfolio that's cash flow positive by $70,000 and you're going to lose $15,000 of that every year just by holding on to this apartment. Wow. And so then I helped him sell it through a Brisbane agent. He sold it, he probably lost $20,000, $30,000 on it. But it was the best move at the time because there's no guarantee he's going to get capital growth, and he didn't want to go overseas with a cash flow negative property. And so at the moment, given the current environment, I'm much more comfortable selling, I guess, first timers or first home buyers a property that's cash flow positive. If they lose their job and can't afford to live it anymore, if they want to live in it for the first 6 to 12 months to get the first home buyers grant, they could then move back with their parents, rent it out, and have a tenant fairly quickly.
So I had a lot of thing going on in the internet, mostly from Americans, real estate agents, like, don't buy a house.
Yeah.
Buying a house, it's not a good idea.
Yeah. Okay.
Invest in bulk properties.
Yeah.
Never buy a house. What do you reckon?
As we were talking before this podcast began,
yes, that's what
I always look at the marketing pitch. It depends on what they're trying to sell. And so, just because they're telling you not to buy a house, I guess you need to look at what they're making out of the process, what their aim is. And the way I look at it is, I make a commission for selling a property. And then after that property is completed and rented out, then it's 100% owned by the purchaser. I no longer have anything to do with that property, and I find that's a fairly clean transaction. And in Australia, kind of the Australian dream is owning a property, owning a house. And the other thing is, if there's no body corporate, insurances can be kept to sometimes as low as $500 a year. You can get landlord's insurance for if your tenant damages your property. And a lot of Australians especially are quite comfortable with that because, as I mentioned before, they've got that Australian dream of owning a home. And then also they can control a lot of it. They go, okay, if there's a problem with the pipes, they can call a plumber out to fix it. If there's no elevators that are going to cost hundreds of thousands of dollars to replace, there's no water damage from apartments above yours. It's just a simple house. And so there's a lot of money to be made, I guess, from my end of the business in selling apartments. Like in Melbourne, especially at the moment, some of the developers I work with are offering some really, really big incentives. And for the right client, it works. Like I've sold an apartment in Melbourne 2 weeks ago because the client needed a tax deduction. The client was, I guess, higher end, liked the idea of having an apartment in the city in Melbourne. And so that works quite well for them. They can afford it. It's part of a larger portfolio. I don't think it's going to do them any harm. And and it probably will get capital growth at some point. I'm not saying apartments can't grow. I bought an apartment in Frankston in 2014, and that's nearly doubled in the last, I guess, 6 years. So, sorry, go on.
No, so the buying Australian dream is like buying a house, because when people buy a house, maybe they're buying it not for like an investment, they're buying it for their family, right?
Yeah.
Because a lot of people, like when I talk to a lot of people right now, hey, this particular person said buying house is wrong. Buying a one single investment property is wrong, because I think they are comparing with the United States market to Australian market, right? I wanted to come to that one because both work in totally different way, or they all work in the same, kind of environment. Like the investment, when it comes down to property investment, real estate, buying a house is different from United States, right?
Oh, it's very different. Yeah,
that's because everybody get misunderstood it.
Yeah.
I think a lot of people get caught into that idea of like, oh, buying a house is wrong, and now they wanted to follow the same strategy what Americans do.
Yeah, okay.
And there are a lot of real estate agents. When I spoke to them, they said that a lot of people are saying these things right now because they are comparing America with Australian market.
Yeah.
Do you want to talk about that a little bit?
Yeah, I mean, I'm an American citizen, so I have a decent understanding of American culture and the economy. And I mean, you got to look at where they came from. So during the GFC, America was hit very, very badly, and some properties just plummeted to 5% of their original value. One of my friends during that time told me he was going on a bus tour in Las Vegas where he could buy, I think it was up to 600 properties for $1 million. What? And he was kind of up in that kind of wealthy end, and he could afford that. And he said, hey, what's the harm in buying this many properties, But then he was like, I don't know the condition of them, I don't know whether they rented out or not, but I'm just getting it at a very, very low price. And so, whereas in Australia, during that GFC, properties in good areas actually continued to grow. And so we're not coming from a point where we've had massive price reductions. In fact, the property market in Australia has been really quite steady.
So there are the fear was going around in the people, like the properties are going, the values are going down.
Yeah.
Because of this thing. Because when I look at it, no, it's not.
Yeah.
Because you're paying the same rent. You're doing everything same.
There are, I guess, discrepancies in the market. So one of the things I look for is the purchase price of a property versus the rent you receive for that property. Yeah. So I purchased a couple of townhouses in Melbourne recently, and for example, a townhouse worth $750,000 might only be bringing in $520 a week. And so you look at that and go, it's not a great rental return based on the value of a property. Whereas these two properties I've just recently purchased in Southeast Queensland, purchase price of $559,000, and I'm getting $680 per week. And so the reason for that, I find, is that in Melbourne and Sydney, to a certain degree, you've hit that rental ceiling of where a lot of people don't want to pay more than that. Regardless of what they earn, you just don't want to pay more than that. You know, if I'm in Sydney CBD, that rental ceiling is probably somewhere around about the $1,500 to $2,000 a week. But, you know, myself, I would not pay that much in rent. You know, I'd go rent something cheaper. Regardless of how it made me look or the quality, I go, I can get a nice place for cheaper than that. I'm not going to spend $1,500 to $2,000 per week, you know, on rent, because that to me is dead money. Whereas in Queensland, you look at it and go, okay, at the moment, that rental ceiling is slightly higher because properties are cheaper. And so, you know, when purchasing these last two properties, you know, those dual occupancies I was talking about, I have a 3-bedroom house, a 2-bedroom house. Yes, they're joined by a common wall down the middle, but, you know, they're separate dwellings with separate kitchens and bathrooms and garages, etc. Then I can rent out the 3-bedroom side for $350 to $370 a week to a family. And that family might be working at Bunnings, they might be working at Coles, it might be professional, but they can afford $350 to $370 a week. You know, most people in Australia can. During COVID, with job seeker payments, you know, that $350 to $370 a week rent is very achievable. And then the other side being the 2-bedroom, I can rent that out for $300 a week. Once again, doesn't need to be a high income earner renting my property. It's everyday Australians that, you know, can afford to pay that rent. And so that for me it's not a glamorous strategy. Like a lot of the time clients look at me and kind of say, oh, I'd rather buy in these nicer areas. I'd rather buy in these more expensive areas. And I say, okay, well, is that an emotional decision? You know, or is that an unemotional decision? You like a suburb, so you would like to invest in that suburb. When I invested in Frankston North in Melbourne, all of my friends, everyone at work gave me a really hard time about it. And then within 3 years, those properties are, you know, that today is my best capital growth has been in Frankston North, like in the worst part of the worst. I bought a 3-bedroom house on 650 square meters for $265,000. And then today it's worth about $550,000.
So don't judge the place.
No.
When you come
if anything, you look at, you know, I always look at a certain number of factors I look at whenever I'm trying to find investments. And a lot of it has to do with government infrastructure going into an area and the median price of a suburb versus the suburbs around it. And so, you know, like I say, these boutique developments in, you know, higher end suburbs are either for people with larger portfolios or they're for emotional investors. You can make money there, but it's, you know, once you go above a certain price range, once you go, you know, just the investment, sometimes it's no longer makes sense.
No. So what are the biggest changes that you've seen in the last 10 years when you come down to the real estate?
Biggest changes I've seen is just locations. So when I moved to Melbourne, everything we were selling was within a 10-kilometre radius of Melbourne CBD. So that was 2012. And the average price we were selling in was around about that $480,000 to $550,000. And so the biggest change in that last 10 years is now in that 10-kilometre radius of the CBD, you won't get those types of properties for under, you know, $800,000 to $1 million. But then again, the rent has not caught up that much. So those properties that might have been renting out, you know, I bought a property in Moonee Ponds, which is about 11 kilometres north of Melbourne, for $620,000 in 2013, I believe it was. And at the time I was getting $575 a week rent for it, and that was great. And now if you look at the value of a townhouse there, it's gone up considerably, but the rent has not really moved too much. So one of the things my real estate agency does in Melbourne is we target rental managements. Last year we purchased a rent roll of, you know, rental properties. And the reason we do that is for the ongoing management fees. And also, you know, when I sell the properties, I like to have a hand in who rents them out so that the purchasers have a single person they can come back to if their property's not been managed properly, or if they're not getting enough rent, or if it's sitting vacant. I want them to be able to come to me and say, can you sort this out for me? You know, rather than me just palming it off to the local real estate agent, I can say, well, yes, so-and-so's in charge of that. I can give them a call right now and I can find out why your property hasn't rented out. And one of the things I find in Melbourne is that the rental return you get for these properties is just not what it used to be, because you've had some really strong capital growth over the last 5 to 7 years. And now it's time for, in my opinion, now it's time for the property market to flatten out a little bit and the rents to catch up. Whereas look at Southeast Queensland. Last year I sold 2018, I sold one property in Queensland. 2019, I sold about 45 properties in Queensland. and probably 40 of those were to Sydney and Melbourne investors. And the reason for that is we've just had a fairly flat period in Queensland. Rents have been catching up, so you get quite a good rental return. And now, in my opinion, it's time for the capital growth to start kicking in, and the value of these properties to start increasing.
So, I'm going a little bit political here. So, the foreign investments, property buyers from the overseas, does that change the scene of Australian real estate? Does that make the people, like normal Australians, to buy the property hard for them, the foreign investments?
In my opinion, it doesn't.
It doesn't?
I know a lot of people think that's...
Because I see that a lot
yeah.
going around, because of the foreign investment, the land price has gone higher, the property price has gone higher.
Yeah.
The rent has gone higher. So...
Yeah, I guess that, there's two ways of looking at, I guess, everything. But the way I view it is that money coming into Australia is strengthening the property market. That's a good thing for Australians that have purchased property. So, for example, my parents purchased a property for $200,000 back in, when I was born, I think 1985. Yeah. And they sold it 3 years ago for $1.75 million. And so, I look at that and go, yes, it becomes rising house prices it creates a barrier for new entrants to the market, but it's not an insurmountable barrier at this point. And it's the type of thing where a lot of these foreign purchasers have either, gone in as a family. I've sold to a lot of foreign purchasers. Quite often they've gone as a family or a syndicate, or they've, had help from their parents. I think probably the best way of entering the real estate market in Australia for a new home buyer is also with the help of parents. So on one hand, you go, okay, well, so-and-so would like to buy his first property. Government's giving them, as I said, $40,000 plus, which foreign investors don't get. And at the same time, if their parents have bought a property 30 years ago that's, gone up in value, it's doubled and then doubled again, then doubled again, then, that's where they should look to for a bit of help to get into a property market.
So if a first home buyer, right, if they're just like a young couples, they wanted to buy a new house, what should be their a minimum of savings and everything for an investment or a deposit?
My youngest brother is 20. He's buying a property at the moment, and he has about 27,000.
27,000.
Yep.
That is achievable.
Yeah, that's very achievable.
So that means anybody can buy a property in Australia.
Yeah.
On a even if they're on a 45 to 50,000.
Yeah, one of the hurdles at the moment is the, I guess, banking scenario in Australia right now. Coming off the back of the Royal Commission, coming off the back of unemployment through COVID, then banks are rightly, I guess, applying more scrutiny to loans before they give them out. And so what I find to be the best way of doing it is having a solid income. So my younger brother, he's working full time. He earns a decent, not an extravagant wage, but like a decent wage. And the bank looks at that and says, okay, he has a full-time job. We're going to lend him 90% to purchase this property.
If you have a full-time job, is it guaranteed to get a loan for that?
Not guaranteed. It depends on the property they're buying as well. One of the other issues we have in the banking industry right now is, which once again, it's a good thing that's happening, is valuation. So when you go to purchase a property, then you're going to sign a contract. You're going to present that contract to the bank or broker, and then they're going to do their own independent investigation on the value of that property. And so one of the issues we're finding, and it's been a bane of the real estate existence, over the last kind of 4 or 5 years, is that sometimes you can pay $550,000 for a property, and then the bank valuation, which they outsource independently, could come back at $480,000, which means there's a $70,000 discrepancy between what you're paying and what the bank's willing to lend you. Because they might lend you 90% of $480,000, and they want your deposit plus that extra $70,000 to bridge that gap. And that means that you just, like for my younger brother, that just means that he couldn't even purchase the property because he wouldn't have that extra $70,000. And so what you can do then is you can request another valuation through a different bank. And sometimes, too much to my dismay, sometimes you'll get another valuation that will come back at purchase price. So they can differ by that much. So once again, using my two recent ones in Logan as an example, they're side by side. The blocks of land are within 10 square meters of the same size, and the designs of the homes are within 5 square meters of difference. Valuation came in on same bank, did both of them, but when they sent it out to the panel of valuers, 2 different valuation firms were selected. And even on those 2, there was about a $35,000 discrepancy. One of them came in very close to purchase price, and the other one came in about $35,000 lower. And so the bank, because I've purchased with them before, they agreed to use the higher of the 2 valuations. But in some instances, depending on the bank you use, they say, no, we have to use the lower of the 2 which has come in, and we want you to put an extra $35,000 into each purchase. So that's one of, I guess, the hurdles. But if you look at it on a positive note, it means that the bank is not going to lend you more than you can afford to repay on a property, and they're also not going to let you overpay for a property. So any of those issues where people say, I don't know whether I'm paying too much for this property, I don't know whether so-and-so is asking too much and is ripping me off, you kind of say, if the bank's willing to lend you money for the property, then you can be pretty confident that it's not overpriced.
So it's a safe game.
As long as you do it right, it's quite safe. Like there's a lot of issues that come, when purchasing property. It's not an easy process. And like I said earlier, like my whole business model at the moment revolves around getting rid of the risk for investors. So talking about some of those risks that can happen is, you can have issues with your valuation, you can have issues with your finance, you can have issues with the property itself, you can have vacancy issues, but through, I guess, a bit of research and through market knowledge, you can overcome most of those types of things. So when I go out and I source an area to purchase properties in, or to find properties for my investors to purchase, then I'll look at a number of factors. And one of the biggest things there is, first of all, the owner-occupier rate, which means how many people in a suburb own and live in their homes as opposed to rent in a suburb. And the other thing is the rental vacancy rate, which is of the rental properties in a suburb, how many are vacant at any one time.
So one more thing I want to know. So you're saying that to not look into American market and compare Australia?
I'm not saying don't look into it. Like I've got someone at the moment through one of the accounts working with that are providing American properties for sale. And that's something which I'm pitching to certain clients. But I think it's not as simple as going, this is working in America, let's do the same thing in Australia.
It's not going to work.
Yeah.
So it's totally 2 different. Because I attend a lot of events, so I've seen the speakers from Americans saying these things like, hey, don't buy a house. Buying a house is a bad move, invest in real estate. And people get confused, and even because it's going around, because I have seen in the Facebook where people are sharing these things.
Yeah, it's all over Facebook and social media at the moment.
Yeah, they're just going around, don't buy the house, creating that panic, buying a house is a bad thing. Like, you know what I'm trying to say.
Yeah.
But when I look at Australia, I think it's the safest option, having a home.
Yeah, I think it's definitely should be the basis of an investment portfolio in Australia. Like for myself, I used property to get myself to a point where I was comfortable and where if I wanted to, I could have, I guess, retired on a reasonable income. And then now that I'm there, I've then decided, no, I don't want to do that. I'm going to go and continue growing my portfolio. And at the same time, I've diversified into, as I said before, I'm quite heavily at the moment into cryptocurrencies and also forex trading. And so for me, I can do that with confidence that even if I suffer losses through those, I've got a solid property portfolio and I've got a solid income coming in.
That's right, because you use the cash flow, extra cash, and you invest in whatever money that you get it through the real estate. Then you make investment in like a crypto and everything.
Yeah, so I'm of the opinion that you should be involved in as many different investment opportunities as you can. I'm not just, only real estate or only shares or anything. I look at it and go, you can make money in a lot of different fields. And if you have the capacity, then you should involve yourself in as many of those different fields as possible.
But real estate is a very strong investment.
Yeah, I find real estate is a very good core investment strategy.
Yeah, that is proven throughout of the history.
Yeah, I mean, I can honestly say, I've not lost money in the last, I'm not one of those investors who've been investing for 20, 30 years, but since my first purchase, I've not lost money investing in real estate. I have lost money investing in businesses. I have lost money investing in cryptocurrency from time to time. I do currently, sometimes lose. Like last week, I had a week in my trade, and I would never advise. At this point, I can't, but I would never advise, my investors that they should be investing in anything other than real estate at this point.
That's a very because you know your game, right? Because a lot of people just like me, because I don't know like how this real estate work, but all I do when I look for it, what I see is the fear, like scary thing.
Yeah.
Like, oh no, this real estate is going back bad. Like, when you look at the articles, there is nothing positive about Australian real estate market, right? So the last couple of months, I've been talking to some people from real estate industry, and they're saying they're doing great.
Yeah.
I don't understand, what I mean? So what they're trying to achieve from the media or the news or the articles, like why they saying that investing in real estate is a bad move right now. You know what I'm trying to say? I spoke to all of these people, and they all say like, we are doing great. I think we are the only business doing great during this COVID time.
Mm-hmm.
You know what I'm trying to say?
Yeah, definitely.
It's a very safe game, right?
Yeah, and it's funny because 3 months after I started working in real estate, back in 2012, I spent a lot of time, because I was like, okay, I'm out here pitching to investors, I'm talking to clients, I'm selling properties. I want to find out what the industry is actually doing. And so I'd spent about 3 hours online looking at all these articles, and I just ended up freaking myself out and seriously thinking about quitting my job, because I saw so many doomsday articles saying that property prices are going to plunge, we're in a massive bubble. And, I had to kind of talk to my boss, and I had to do a bit of research to go, okay, no, not all the articles are negative. And I've found that, since that point, anytime you jump online, anytime you Google it, you can find negative articles about real estate, especially a lot at the moment. And some market segments have really struggled. I know last year in Sydney, a lot of my clients were quite unhappy with the prices of their properties because media was reporting drops of up to 20%. And so you go back a little bit further and say, okay, well, property prices in Sydney over the last 5-6 years had jumped up around about 38%, and then dropped off by about 20%, probably because it's a little bit overinflated at the time. Like people were going to auctions, including some of my clients going to auctions and bidding $200,000-$300,000 over the reserve, just because they wanted a certain property. And so my issue with auctions in that situation is, it's great for the seller. It's great for me if I'm the seller and I've just made another $200,000. It doesn't increase the value of the property by $200,000. Like all it does is it creates an artificially inflated property. So when things return to normal, the next door neighbour's like, well, I'm not willing to pay an extra $200,000 for this property next to mine. It's exactly the same as mine. And so, other people come into it and they look at it and go, yeah, I'm not willing to pay that extra. And so the property prices don't really even drop so much as they just return to normal. And so, there's always, you can always freak yourself out with the fear factor. A really good friend of mine who is heavily into trading and very, very successful at it, he quite often tells me that we're in a massive bubble and property prices are going to drop by 50%. And I kind of say, well, for myself, that would not be a terrible thing. If I'm not in a situation where I have to sell my properties, the repercussions are going to come from a massive drop in the property market. It doesn't have to be a negative thing.
That's true.
So you can insulate your portfolio that say, okay, well, if I've got certain cash flows coming in and I've got certain diversification in my portfolio, if that did happen, however unlikely, it doesn't mean I'm going to go bankrupt.
That's true. Even I was talking to one of my friends from Melbourne, and she's a real estate agent, and she told me like the government considers real estate as, even during the lockdown, as essential. You know what I mean? So it's never go out of business. It's still like because even the government understands it's an essential work.
Yeah, I think we're at a point now in the Australian market where the worst thing that could possibly happen would be 50% drops in prices.
But it will go up again.
Yeah, it would. The sad thing about that is that the wealthier investors would probably, like the rich would get richer and the poor would get poorer in that kind of environment. And so what you would find is
what advice do you have for the poor?
I guess poor is a relative state of mind. Yeah. My advice is just, the good thing about Australia as a country is nobody's put in a situation where they can't succeed.
That's true.
Like anybody, regardless of their background, can succeed in Australia.
That's a great
especially with at the moment, like look at the interest rates where they are, government grants where they are. Anybody could go out and save that $26,000.
I think this is the best time for it to start a business too.
Yeah, I actually think this is the best time in real estate. I mean, once again, I'm not an investor that's been in the market for decades, but from my own knowledge, I think this is the best time to be investing in property in the last kind of 15, 20 years.
Something gonna like a fresh and start new. People have equal opportunities, and instead of getting, scared and this is happening, just do more research and go to the right people and get advice from them. Yeah, and this is the best time for the real estate.
Yes, like I had this conversation with my younger brother, him being 20, him going to the market for the first time, and to him losing, I guess that deposit would be a massive deal. And we're like, okay, well, if your interest rates are so low that basically you could, rent the property out for $200 a week and still have your mortgage covered, the real estate agency will give you a 3-year rental guarantee at 5%, which, they've kind of confirmed to me. I do tens of these, every few weeks kind of thing, and they've confirmed to me that they're happy to honour those even in the state. We haven't had an issue with it. We haven't had issues with tenanting these properties. And so he's got a rental guarantee for 3 years. He's got very low interest rates. If he wants, he can lock those in at, sub 4% for 5 years. And he's got a situation where he can afford to hold on to that property for that long, and it's cash flow positive. When I started selling properties in Melbourne, would sit down with clients, would say, okay, you can buy this property, it's only going to cost you $70 a week. And people thought it was a great deal. I can buy a $500,000 property, it's only going to cost me $70 a week. Whereas now it's like, okay, you can buy a $500,000 property and it's going to put $150 a week in your pocket. And we can, here's the analysis from an accountant or a financial planner that will show you that this is the case.
That's true.
And so where else have you been able to do that? And then on top of that, I haven't taken them up, but I've got borrowings with a couple of major banks in Australia, and during the COVID lockdown, you get the emails, you get the calls saying, do you need to put your mortgage on holiday? Do you need to go on a 3-month mortgage break? And so the fact that you could purchase a property, and some of the banks are even offering the brand new loans, getting them approved, and then offering the 3-month break straight away. So where else can you buy a property and then not pay for it for the first 3 to 6 months?
Yes.
And so you're not saying that someone should do that. Like I always believe before, purchasing a property, you need to have all your ducks in a row, have your savings plan. Like you don't want to be buying it just frivolously. The first time, after I made that offer on that first apartment, it was accepted. I was happy, I was celebrating, and then I woke up probably 2 a.m, just freaking out, going, hang on a second, I'm now liable for, $650 a week, every single week for the next 30 years of this mortgage. And then, it stressed me out. I was like, I don't know if I can do that. But then, I kind of liken it to anything really. Like, you've got to take that first step of faith almost. And, looking back on that property, as I said, I only kept it for a few years. I sold it and made a profit over $100,000. And it wasn't a bad move. So you don't need to look at it in terms of what's the worst that can, you can look at it in terms of what's the worst that can possibly happen. And, if that still makes sense, then you can purchase. So, when I'm presenting something to a client, we say, okay, here's a property worth $550,000. We're expecting it will get $650 to $670 a week rent, but we've done our calculations of $580 a week. Are you comfortable with that? Let's jump on realestate.com. Let's see the cheapest property that's renting out in that area. Do you think your property is going to rent out? If you want, we can drop it down to $570, $560. Find a level they're comfortable with. And then same thing with the interest rates. I find with a lot of the older clients, who have lived through interest rates of like 15 to 17%, they just think that they just cannot wrap their heads around, 2.5%, 3.5% interest rates. Right. And so their question to me is always, what if interest rates go back up? And so then once again, when we're doing those calculations, we go, well, what is an interest rate that you're comfortable with? I had a client 2 weeks ago and they said, we want to be able to fix our rate for 10 years. And so we worked out what's the, jump online, what's the rate we can fix this for 10 years at? Let's use that figure. I don't suggest that you do fix it for 10 years, but if you wanted to, you could do that. And so then you're looking at the investment, a scaled back version of it, saying, okay, if interest rates are higher, if rent's lower, if it's vacant 10% of the time even, and then you use that as a very realistic, probably an overly realistic scenario, and say, if it still makes sense to purchase this property, then you can go ahead and do it. And so, sometimes people go, oh, that's never going to happen. Other times people go, I would like to, factor everything. I'd like to factor 7% interest rates in. I'd like to factor a reduced rent in, like to factor a vacancy period. But the biggest questions I always get is, what if the property doesn't rent out? What if it doesn't go up in value? And what if interest rates rise?
That's true.
And so you say, well, we can't really control the property going up in value. That's kind of something out of our control.
I agree with that. Like, I always tell people, right? Stop comparing 20 years ago what was the price of this particular thing.
Yeah.
It doesn't matter if it is a property. I'm talking about anything. Even if it is a pencil.
Yeah.
Maybe 20 years ago it may be 5 cents.
Yeah.
You can't compare. Back in the days it was only 5 cents. Now it's $5 or $3.
$2.50 or $3 for a pencil.
You can't do that. Same when you come down to the property. I think this is the same thing.
Yeah.
Yeah, so I get what you're trying to say. Anyways, Aaron, thank you so much for attending this podcast. This is such a great value for a lot of us, like including myself. I have a lot of misunderstanding about investing in real estate, kind of cleared everything. If you wanted to give any advice to the investors, like first-time buyers, and if they are really scared to, start investing in the business or anything, investing in the properties or anything, what advice would you give to them?
I'll just say start at a level you're comfortable with. Buy a property that you can sleep at night owning that property.
Yeah.
I always think it's a good idea to I guess get a solid 9-to-5 job until you get to a point where you can move away from that. Like being self-employed now, I'm a big fan of that. I'm an advocate for being self-employed, but at the same time, there is a lot to be learned from just working 9-to-5 and getting the solid paycheck and using that to, I guess, at the moment, that's probably the biggest thing when it comes to lending. That lenders want to see that solid paycheck. They want to see a salary that comes in from a separate employer to yourself week in, week out. And so, sometimes it's good just to do that to get your first property. And after that, And the other thing, I've got quite a few people at the moment trying to talk to me about setting up businesses. And I said, well, is there any business at the moment that you could not work a 9-to-5 job or cannot work a part-time job and still do your on the side business? And then you've got 2 sources of income. And when one of them gets to the point that it overtakes the other, one of them gets to the point that gives you that freedom, then we can walk away from the day job, I guess. But one of the things I'm not a fan of is people that they want to live the dream and they want to kind of like they want to feel good about what they're doing, but then they're only trying to work 2-3 hours a day. They're trying to say, I can make this much money working 2-3 hours a day. It's like, well, you can at a certain point, but you've got to put the hard yards in to get there.
Awesome. Anyway, thank you so much, Aaron.
No worries.
It was great podcast, to be honest.
You did.
Yeah, thank you. All right. If you like this podcast, please like and comment below, and don't forget to subscribe. Stay blessed.